My name
This
is Cameron
conference will
Keller
now be
with Keller
recorded.
CPAs, and I'm going to jump right in and get going. There is a lot of information that we're going to try and cover today. I'll probably talk pretty fast, and I'm guessing that you will not grasp all of it. And if you don't, I think that's okay. And we're going to be available after this, or after the presentation, for phone calls. I'll give you my contact information as well, which you can reach out to us and chat with us as well on additional questions. So I'm going to start first by going to some PPP loan facts. This is what we know about the PPP loans so far. I think it's very interesting. So the first thing that I'll show you is there was two different rounds on this PPP loans. And the first one, the data that we have that I have up on the screen is data through April 16th. The first day of application was April 3rd. And so from April 3rd to April 16th, here are the loan facts regarding the PPP loan. If you look, you can see a pretty tremendous amount of loans. This is nationwide. The top bullet is 1.6 million nationwide on the PPP loans, 4,900 lending institutions. Idaho loans accounted for 13,627 total loans in the first wave, and $1.8 billion was funded. Now, the interesting couple of things are the next couple of bullets. The loan size under $150,000 accounted for about 74% of the total loans, but only about 17% of the total loan dollars. The average loan size in the first round was $206,000. Now, what happened in the first round is lots of bigger businesses, and I'm sure you've heard on the news, lots of bigger businesses were applying, lots of publicly traded companies were applying. And then more guidance came out, and it's very interesting to see what happened in the second round of funding. The second round of funding, as you'll see, I think hit their target audience a lot better than the first round of the PPP funding once they established additional rules of do's and don'ts. And so I'm going to show you the second round of PPP funding. So 2.2 million more loans from April 27th to May 1st. A little bit more in way of lending institutions, 5,432. Idaho loans had an additional 12,400 for an additional $719 million in way of loans. The loan size, though, this is what's interesting. The loan size under 150,000 accounted for 90% of the total loans versus the 74% in the first round, and it accounted for about 36, almost 37% of the total dollars. The average loan size, though, was $79,000. So it went from 206,000 down to 79,000. So a pretty dramatic change in the loan size. So again, like I said, I think the second round of funding kind of hit the target audience as to who they were trying to hit a little bit more. So some loan facts, some things that you need to know that are interesting, I think. According to the AICPA, which is our national governing body for CPAs, those who receive PPP loans will be released to the public. And in fact, what happened is someone created a data mining software that scraped SEC filings. SEC filings are for publicly traded companies. And this data mining software actually produced a list of publicly traded companies that have taken a loan and how much. If you go to this link, it's very fascinating because you'll also see the loan amount that came in, and then on some of them, you'll see a loan, a cross out of that loan, which means they actually gave the money back. It is pretty fascinating to see the size of loans and to see how many publicly traded companies qualified for these loans and actually took the loans. I mean, some of the well-noted ones that you'll know is like Harvard, their foundation qualified and took one of the loans. But you'll also see I think it was a $6 million. You'll see that they actually have the loan crossed out, which means they gave it back. There was several different. Ruth Chris is one, and their group qualified for loans, and then they also gave it back. There's actually quite a slew of different publicly traded companies that qualified for the loans. I guess one other thing I should mention, just so you know, so that you're not scrambling to write everything down, I think we will be making this slide deck available to you at a future time. So I just want to make sure that you're aware that you should be able to get the slide deck, so you don't have to scramble to write everything down. You'll get it, I think, eventually. So A couple other things that I think are interesting. The rules and guidance on these loans. Again, the government was weighing out the option of saying, hey, how do we get the money out so fast to these businesses that are struggling? And then how do we monitor, and how do we create rules, and how do we create the guidelines? Essentially what has happened is the rules and the guidance is essentially changing almost on a daily basis. And what we're finding is there's going to be exceptions to the rules, and then there's going to be exceptions to the exceptions to the rules. It is it's an ever-changing thing, and over the last 6-7 weeks, we pretty much our first thing that we do is get up and check the guidance that has changed for that day, or the guidance that has come out for that day. I will tell you, I have a great technical team here at our office at Keller CPA that helps keep us up to date and helps do a lot of fact checking on making sure that we're up to date and up to speed. And like I said, we do that on pretty much a daily basis. With changing rules, though, make it pretty difficult to know how to operate, how to plan, how to qualify, how to not qualify, what happens. And I think this next slide kind of shows you what you're dealing with. Really, if you've ever seen the Hunger Games, the PPP loans are very similar to the Hunger Games. And you think about the ever-changing rules in the Hunger Games, and I think that is kind of how PPP loans are working. And you can see the famous quote, "And may the odds be ever in your favor." We're kind of left to our own guesses sometimes as to how we're going to qualify, if we qualify, how much we should have taken, how much we shouldn't have taken, how do we pay back, do we not pay back, how much is forgivable. Those are all the different things that we're going to talk about. But like I said, similar to the Hunger Games, the rules constantly are changing, and it's like a live, real life game that we're in. So what I want to do is first start out with what I'd call loan application compliance traps. And so I'm going to go to this first slide here. First of all, it's very, very important that you understand this is probably like a loan that you've never seen before. This is a self-certifying loan, meaning the borrower has 100% responsibility of the information. A lot of times you go to a bank and you feel good about the bank, checking your numbers, checking things. There's an underwriter with the bank, and then they qualify you and make sure that you're dialed in. This is not that way. Lenders can rely on the borrower's information if it just seems reasonable, but they don't have to do any calculations. They don't do any self-checks. They don't do anything. It is 100% self-certified. That is a very important thing, because I don't think most people realize that the banks are simply grabbing the information. Some of them are doing more work than others as to double checking numbers and things. But I have already seen so many different examples of clients saying, well, that's what the bank told me, or that's how the bank calculated it, but it's actually not consistent with what the actual rules are. Again, the banks were not necessarily, because they were trying to get the money out so fast, the government was trying to get the money out so fast, they didn't want the banks to have to spend 6 and 8 and 10 weeks trying to underwrite and trying to work through this process. With that being said, though, you as the person who is applying for the loan are the one who is certifying to the numbers that you're providing. And that will come into play or be important. I'll talk a little bit more about that later. Another thing that is very, very important is I have, with our client base, many of our clients, after we did some of our initial webinars to get the information out there, applied for these loans with the banks and submitted the information they needed to the banks. And what we are finding is that most of the amounts of the loans, or the loan dollar amounts that people have qualified for, are incorrect based on what the rules are. An example would be last week I was dealing with one client. They got their funding and they said, okay, I want to just make sure I got this right, and how do I do this? And their concern was, I don't think I can spend all this money because I'm trying to get it forgivable, but I don't know if I can spend all the money. And what had happened is when we started going back and double checking how much they applied for on the loan, they applied for $71,000 or got qualified for $71,000 more than what they should have. Now that went through the bank. The bank didn't catch it. As I mentioned, it's not the bank's responsibility to catch it. It was you as the borrower's responsibility. So the problem with the $71,000 extra in funds is twofold. Number one, there may be a potential fraud situation where SBA comes back and says, hey, you qualified for too much. How did you get this money? On the back end, when we go to apply for forgiveness, there's going to be, I think, some additional certification that's going to have to happen. And if I've got too much money or received more money than I was entitled to, I got a fraud problem that I would be concerned about. The second is this. We'll talk about the forgiveness rules, but one of the biggest challenges is if you receive forgiveness, or to be able to receive forgiveness, you have to spend so much of the dollars. When we were looking at the calculations, she was going to fail the forgiveness tests because she couldn't spend enough of the dollars. So you've got a fraud problem. Then on top of it, you may get to the end of this and calculate it and realize that you also aren't able to receive forgiveness of the loan because you weren't able to stay in compliance and spend enough of the money, because the money that you got, the funds that you received, was just too much to be able to spend it. And so that is some of the first things that I want to just make sure, loan application compliance traps that we have seen so far. There's a couple of additional ones that are really, really important. The bank loan applications changed the questions that are on the original SBA application. So certain questions from the bank standpoint are not asked until after you have been approved for the loan. The problem is the original question has 4 or 5 things. The original application with the SBA has 4 or 5 things that you certify to. On the back end, if you wait to certify to certain things, those questions are mixed in with a lot of other paperwork. And so what is happening is people don't fully understand what they are certifying to. So a huge trap that we're seeing is this. There is one certification that you have to be able to certify to. Any business owner greater than a 20% owner has to certify to this question. It says current economic uncertainty makes this loan request necessary to support the ongoing operations of the borrower. And that is a vital certification. So an example might be, well, if I have $300,000 or $400,000 in the bank right now, and I'm applying for this loan, and I read that certification question, I may think twice about saying, yeah, I think I'm okay. Current economic uncertainty makes this loan request necessary. So it's hard to know whether it is necessary or whether it is not necessary to support the ongoing operations if I have funds currently in the bank. If you're like most of our clients, most of them are saying, well, I think I'm okay right now. I think I could get through the next 8 weeks. It's really going to be what's going to happen in July, and what's going to happen in June, and what's going to happen in August. And the problem is right now there is not a lot of guidance as to whether you could certify or meet that first certification question. With that being said, that you're worried about July and August and September. The only guidance we have 2 or 3 different little tiny bullet points from frequently asked questions, but no real guidance. The one thing that it says is economic need at the time of the loan application. So that's important that you understand and look at your economic need at the time that you are applying. I don't know if that means that it doesn't really matter what's going to happen in 4 or 5 months. You're supposed to take your economic needs at the time of the application. That may put us into a tough spot for those that are saying, hey, in 3 or 4 months, I think I'll need the money, but right now I may not need the money. So that's one area. Another thing is there an ability to access other sources of liquidity? And that's another question that we have to ask ourselves. If I had a line of credit, for example, of $100,000, would I then need this loan? Could I certify again if I had access to other sources of liquidity? A couple other things that I think are important. I guess the last question I would ask is, if the loan was not forgivable, for you to be able to certify to this, one of the other questions that I would personally ask is, if the loan was not forgivable, would you have even applied? And that may help you answer the question as to current economic uncertainty of this loan. This question is the very reason that most of the bigger companies, or a lot of the bigger companies that are returning funds, are returning the funds, because it's going to be really hard for them to certify to this question, especially when several of them several of the bigger companies just had a round of stock sales. So they just sold stock, they just raised money. Like Shake Shack, I think just raised $150 million at the same time that they applied for this loan. So that's going to be a problem. In fact, the guidelines that we have come out right now that have said that anyone that receives more than a $2 million loan will have an audit. That's what has been stated, is that anyone receiving that size of loan will be and over. But they can still take the same premise, the same concept, and they have the ability, the SBA has the ability to come in and essentially audit anyone at any size. And we don't know the forgiveness process on the back end, but what we do know is that there's most likely going to be some additional hoops, some additional certifications, some additional reports that we're going to have to provide. And there may be a time that we have to answer that question and show the reason or the proof why we feel like if we applied for this loan that we qualified to apply for this loan. What the banks did, and this just barely happened, or what the government did, excuse me, is today, actually May 7th, was the original deadline. That if you took money from this loan and then determined that maybe I shouldn't have taken money, you had until May 7th to give the money back. They just extended that, I think yesterday or 2 days ago, to May 14th. So now people are forced to make some real tough decisions. Even if you receive the funding, should you pay it back by the May 14th deadline? These are all things that I think most people did not realize, because a lot of times people were applying for these PPP loans before any of the regulations, before any of the guidance even came out, and really not even fully understanding that question. Again, like I said, if the banks did it on the back end right before funding, but not on the application process, that certification question, you may not have even seen that certification question, or may not recollect that certification question. So we're bringing that up as simply a compliance trap that you just need to make sure that you're aware of, so that you can at least make some decisions and say, hey, was this necessary for me to support ongoing operations? And that's something that every single business is going to have to answer for themselves. There's not a blanket black or white rule. And so that's something that we certainly could try and help answer on, but I would say it's something that you got to feel comfortable with. Okay, so let's say that we've gone through the loan application process, and now once we have the loan, let's go through the very important rules that exist. First, you have 8 weeks from the date of funding to use the loan proceeds. Once you get funded, it's 8 weeks. You cannot hold it, you can't wait, you can't go 10 weeks, you can't save it for later. You have 8 weeks from the date of funding to use the loan proceeds. What can it be used for? Qualifying uses, payroll-related costs, interest on mortgage and debt obligations that were already in existence before February 15th of 20. If you have like a self-rental situation where a different business that you own owns the building and you pay rent to it, that interest on that building does not count as interest on a mortgage obligation or debt obligation. So again, qualifying uses, payroll-related costs, interest on mortgage obligations, rent on leasing agreements, and then utilities. That's electricity, gas, water, telephone, internet. And again, it has to be under contract before February 15th of 20. There is an enormous amount of question on what payroll-related costs mean. Some people have included payroll taxes. Some people have not included payroll taxes. Some people have included work comp. Some people have not included work comp. Payroll-related costs, the definition of payroll-related costs is gross pay. What does that mean? And how about retirement plan? How does that factor in? How about employer provided health insurance? How does that factor in? How does state unemployment factor in? How does FICA and Medicare factor in? Those are all vital and should have been addressed on the front end when you applied for the loan. Again, what we have found is I have not seen one loan amount that was applied for that was accurate as far as what they were funded and using the numbers that they used to fund or to apply for the loan, because the definition of payroll related costs for some of the applications wasn't even out at the time. So it's one of those things, or there was such ambiguity and such question that what I'm finding is most people have applied for a loan and it's either too high or it's too low. It's one of the two things. So those are the qualifying uses. You have 8 weeks to spend it on those things, and we're going to continue to dig into the rules of those. There are 3 different rules that are really important for loan forgiveness, to qualify for the loan forgiveness. The very first rule is this: at least 75% of the loan is used for payroll-related costs. Now, this is important. The next bullet is, this appears to be an all or nothing rule, meaning if you don't hit the 75% rule, then you're not going to receive forgiveness at all of this loan. It's not a percentage. It's a cliff. You don't receive forgiveness at all. 75% next 8 weeks. So the other thing that's important is, if we'll go through this in just a second as to the other things, 25% can be used for, like we mentioned, mortgage interest or interest on debt obligations. It can be used for utilities, and it can be used for rent. What if you don't have enough rent? What if you don't have enough utilities? What if you don't have enough or interest? Payroll can be higher than 75%. It just has to be at least 75%. So payroll could make up 90%. If you can get 90% of the loan proceeds for payroll-related things, then you're going to receive forgiveness. At least you'll pass the first test, I should say. The other thing that is interesting is the way the language writes in the rules. It says that in that 8 weeks, the expenses have to be incurred and they have to be paid. Now, how does that relate to someone who has a payroll on the 1st through the 15th, paid on the 20th, and they receive funding on the 17th? The 17th is when the funding happened. They're going to pay payroll on the 20th, but the way that the rule reads is that it has to be incurred and paid. What we don't know is if that's incurred in the 8-week period or just has to be incurred by the time it's paid. That's an important distinction, though, because the 1st through the 15th paid on the 20th may not qualify for payroll. So one of the things, and this is a huge important thing that you take away from this seminar or from our webinar today, is at the end of the 8 weeks, you will not want to have amounts owing for payroll or for state unemployment or for retirement plan match or for health insurance match at the end of the 8 weeks. So as soon as your 8 weeks is over, if it has been incurred, but then you wait a couple days after the 8 weeks to pay it, again, the way the language reads, we don't think that it will currently qualify for that 75%. So it is vital that you pay out your payroll and associated employer retirement plan match and your employer health insurance provided by the end of the 8 weeks. It just can't be on your books as owed because it has to be incurred and paid. That's the guidance that we have right now. So very important, that's the first rule. So there's 3 different hurdles that you have to pass to be able to get loan forgiveness of 100%. One of them is 75% of the loan has to be used for payroll related costs. Second rule is this. Paid to each employee has to be at least 75% of what it previously was in the first quarter. And there's some caveats to that. For example, if the COVID thing started hitting you in March and you started laying people off, what's going to happen is the government is not most likely, we're waiting on guidance on this, but they're not going to allow you to use the first quarter because the first quarter would be lower wages than what your normal would be. So they are going to most likely kick you back to the 4th quarter of 2019. So essentially what they're trying to do is say, hey, employee, you can't have made, and there's an example. I'll just go to the example. And this is important that you note that it's an employee by an employee comparison. It's not total wages paid and total wages paid in the first quarter as it compares to the second quarter. So an example would be this. We've got John Doe. We have to take an 8-week average in the first quarter, 8 weeks of what their payroll was. So we're just going to assume that it's $10,000. Then John Doe, in the 8 weeks after the loan was received, makes $8,000. So $10,000 minus the $8,000, there's a potential of $2,000 that this employee received less than what they should have received. But all we have to do is meet 75% of the initial pay. So $10,000, 75%. I need to pay this person $7,500. If I don't pay them $7,500, then a portion of it will not be forgivable. Because I pay them $8,000, I'm good to go. There is no forgiveness, or there is no loss of forgiveness. Here's an example number 2. Employee, again, by employee comparison. So every employee you have to do this on. John Doe in the 8-week average in the first quarter makes $10,000. John Doe in the 8 weeks after you receive the loan receives $6,000. So, and the 75% threshold is $7,500. If we looked at that number. So the portion below the 75% threshold is the loss of forgiveness that you're going to receive for that one employee. And again, you have to do it employee by employee situation. So rule number 2 is the amount of wage paid in the 8 weeks in the first quarter, essentially, versus the 8 weeks after you receive the funding by employee has to be at least 75%. So you can't, their wage cannot go down dramatically or more than 25%, or you're going to start to lose some of the forgiveness of the loan. Again, employee by employee situation. So it's only the portion under the 75% threshold that you lose. It's not the total amount, it's just that threshold. So that is rule number 2 to receive loan forgiveness. Then there's a third hurdle that we have to overcome. Full-time equivalent employees is what we're thinking right now, is what the best estimate that we have. Full-time equivalent employee headcount. If full-time employee headcount is reduced, then there's going to be a potential loss of loan forgiveness. So full-time employees can be based on one of the 2 different base periods. So we're going to look at our average weekly full-time equivalents. Full-time equivalent means someone who's worked 30 hours. If someone works 30 hours, that counts as 1 full-time equivalent. So we get to choose which base period we want to use. We can look at our February 15th of 2019 versus to June 30th of 2019 and take our average, or we can take our average weekly full-time equivalents from January 1st, 2020 to February 29th of 2020. I can choose either one of those. So in this case, I'm just going to use my example that I have 11 is my average full-time equivalents. And then I'm going to continue my example. So now full-time equivalents in the covered period. The covered period is, again, that 8 weeks after I received the loan. And I have to spend it in that 8-week time period. And so that's the time period that I'm going to look, and I'm going to say, what was my average full-time equivalents in the 8 weeks right immediately after receiving the loan? In this example, let's say that because the economy was rough and I had to shut down, I lost 3 of my full-time equivalents. The revenue wasn't coming in, so I had to let go of 3 people. So now what we have is this. We have a potential loss of the forgiveness, or a portion of the forgiveness. So the amount of the original loan, we're going to calculate that. Let's say that my amount of my original loan that I got on the PPP program was $100,000. I'm going to divide that by 11, which is the full-time equivalents received or calculated in that base period. So I've got $100,000 divided by 11. So what we're determining is that loan is worth $9,091 per employee. So if I lose 3 of my employees, my base period went to 11, my 8 weeks right after the loan went to 8, I'm going to lose 3 employees times the $9,091 for a total loss of $27,273. So that is the amount of loan forgiveness that I'm going to lose. So you're going to look at rule number 2. And you're going to add up rule number 2, what you lost in loan forgiveness. You're then going to take rule number 3, and you're also going to add up what you lost in loan forgiveness. You're going to add those together, and that will be the portion that is not going to be forgivable. And so then it turns into a normal loan. And so you have 2 years to pay that back, and it's a normal loan. The most important thing though is rule number one, you've got to hit that hurdle first, or none of it is going to be forgivable. So one of the worst things that could happen is if you retained some of your employees, but not all of your employees, and you didn't hit that 75%, but you kept on paying your employees. Like this has happened in the dental world and the medical world, where people have said, hey, I'm just going to keep my employees on, even though we can't even be open because we're a non-essential business. I'm not going to be able to do a lot of work, but I'm going to keep paying them. The worst thing that could happen is if you took a loan, didn't spend 75% of it on payroll, then none of it was forgivable, but you've already spent the money and it's already gone to the employee. So now you're on the hook for a loan, and you really didn't get any benefit because you were paying your employees to kind of just do stuff, but you couldn't really be fully functional and operational. So your employees have the money from the loan, but you didn't spend enough, therefore it's not forgivable. You're on the hook for paying it back. So a terribly bad situation. This exact same equivalent thing will happen. I just got off the phone earlier today, and I think this same exact thing can happen in the restaurant industry, where you had quite a few employees previous to this whole COVID thing. You get the PPP loan, but now you're not essential business. The lobby isn't open. You're closed in the lobby. So your head count by employee and the amount of wages that you're paying to employees is nowhere close to what it was. You're going to have a possible situation where you're going to lose a lot of the loan forgiveness that you've got. And that would be okay. Again, it's very favorable terms. The loan rate, I think, is 1%, and it's over a 2-year window. So it's very favorable terms, but know that it is a loan. And I think a lot of people in this whole program have missed that and are gonna fall prey to that problem. Moving on, there are a couple of different things that could be saving grace for some of us. Still waiting on guidance, meaning we're not 100% sure, but we're still waiting on some things, some guidance. Rule number 2, if the employee's pay was reduced but then is restored back to normal by June 30th, there will be some type of exemption or exception to losing forgiveness. We're just not sure exactly how that's going to look. So the important thing is that you would restore the employee's pay back to normal by June 30th. My estimate or my guess is that you're going to have to keep that employee retained and employed for X amount of time, which we do not know. So it's not like you could just run out, hire them by June 30th again, say that they're going to be paid the full amount, and then the cliff ends and you're done. I think you're going to have to keep them on board for at least a quarter, potentially like 6 months, and pay them at their normal rate. Otherwise, I think you're going to lose and eat into that loan forgiveness. That one, though, again, we're still waiting on guidance. Rule number 3, if the employee headcount was reduced, but by June 30th, you had brought the headcount back to the same headcount that you had pre-COVID, there will be some type of exception again to losing forgiveness. The challenge is we just don't have enough data as to what that is going to look like. So those could be 2 different saving graces. The challenge is the 8 weeks has started for many people, many businesses. And the question is, well, do we operate within the rules that we currently know, or do we hope for one of these rules that we're waiting for additional guidance on? Hopefully that saves us and is kind of our saving grace. I think you got to operate within the 8 weeks and what we currently know, and plan accordingly. The other thing that is really scary for a lot of people is most people didn't realize that the 8 weeks was starting at funding. And when it starts at funding, if you get to the end of the 8 weeks and the 8 weeks is over, it's just like the end of a tax year. You can't do any kind of tax planning at the end after the tax year is over. The 8-week window runs, it's going to be over. You may have exhausted or run out of options if you haven't done the proper planning in that 8-week window. And again, that 8-week window is has started for a lot of people. And so that's a very important thing to recognize and realize. Again, still waiting on guidance on the words incurred and paid. Will incurred be sufficient even if it wasn't paid? We'll wait and see. We don't have guidance on that. What about employees that have left on their own that had nothing to do with COVID? Someone moved, someone just decided to take a different job. Is there going to be some kind of an exception, and can we take them out of our employee headcount and their employee wage? Can we get rid of that? We don't know, but my guess is there'll be some kind of an exception for that. But we don't know, so we're still waiting on guidance on this. The other thing that's interesting is the rules that everyone applied for was so live and living that the person who applied on April 3rd may be operating under a little bit of a different set of rules than the person who applied 2 weeks later after receiving additional guidance. There's a potential that the rules that we're operating under, or that the rules that one company is operating under, are not the exact same of the rules that some other company is operating under based on the date of application. So that's something that's quite interesting and something that we're continuing to monitor. A couple of other things. To maximize loan forgiveness, this is just a recap of what we've gone through. To maximize loan forgiveness, 75% of loan proceeds have to be incurred, and my recommendation is incurred and paid in the payroll for payroll in that eight weeks after the date of funding. I would not hope for a saving grace. I would spend the money 8 weeks, and I would take that final payroll at the end of the 8 weeks, and I would move my payroll cycle up. And so that I paid everything out at the end of the 8 weeks, even if my normal payroll cycle was changed, even if I typically don't pay until the 5th. If my 8 weeks ended on the 2nd, I would move all of that payroll up and pay it out by the 2nd. If it ends on the 27th, and I usually pay at a later time, if my 8 weeks ends, I would move it up and pay it at the end of that 8 weeks before the 8 weeks runs out, because again, the rules state incurred and paid. That's the first thing. Second thing is just keep employees second quarter pay at least 75% of their first quarter pay. The 8 week average in the first quarter compared to the 8 week average in the second quarter, if you can keep it at least 75% by employee, that will be the key. And then the third thing is ensure that by June 30th, you have the same number of employees as you did essentially at the February 5th or at the look back period that we ran in that first quarter per the first calculation. So you got to keep pay and you got to keep headcount the same, and 75% of the loan proceeds has to be used for payroll. Again, important to note that what if you don't have rent? What if you don't have enough utilities? What if you don't have enough internet or interest? Then pay more in payroll. You can always pay employees a little bit more in payroll to try and get them not just beyond the 75%, but to try and get all the way to 100% forgiveness. So that's something that I would consider doing, is potentially giving your employees a little bit of a bonus, a little bit more in pay, a little bit more in a hazard type pay type scenario. That's what I would certainly continue to or look at and monitor, to try and get at least 75%, but get all the way up to the 100 if at all possible. A couple of additional traps, and then I'll conclude here. Loan proceeds. This is something that right now, this is the guidance that we currently have on your books. Most people are wondering, well, what do I do when I get this money? Where do I report it? How do I report it? Do I count it as income? Do I not count it as income? What we're telling our clients is to put it on the books as a loan. Just put it on the books as a loan, and then we're going to figure out what to do with it at a later time once we have further guidance. Right now, the rule is this. The loan will reduce the expenses paid for by the loan proceeds. So the government is not going to allow you to deduct payroll costs when they paid the payroll cost and it wasn't your own money. This is going to be important because your taxable income then is going to be higher because you're going to lose those deductions. So usually if you, again, I'll use the example that we have going right now is 100 grand, that was my loan. I am going to lose, if I get forgiveness on the 100 grand, I'm going to lose 100 grand worth of deductions. And with that being said, my taxable income just jumped 100 grand. So I'm going to end up paying tax on essentially in one way or the other, I'm going to end up paying tax on the loan proceeds because I'm going to not be able to take the deduction. Right now, there's a big push to make it so that you do not, so that you don't lose those deductions. But right now, the current law is that you will lose those deductions. So I've gone through a lot, and I've gone through a lot pretty quick. I'm just going to recap on some other things besides the PPP loan that exist that create some opportunities. I'm just going to make you aware. I'll do that in about 2 minutes. We won't go into any details. I just want to make you aware, and then we'll take some questions. So there's several different new laws that create opportunities during this time. There's the economic injury disaster loan. That is been overshadowed a little bit by the PPP loans, but this is an actual true loan. It operates as a true loan, and it's got a 30-year term, which is a very favorable term and a very low interest rate. I think it's 3.75 over a 30 years, so huge benefit. The other thing, a lot of people have spent an enormous amount of confusion as to expanded paid sick and family medical leave acts. Typically, that's only for employers over 50 employees, but it's been changed that it's essentially all employers operate under this. And if you have a COVID-related situation, the employee can request to go on paid sick. On the before the COVID situation, it was not paid time off, and you had to be, again, over 50 employees. But now the employee can request to go on paid sick if they meet certain stipulations. That's something that's important. Another thing is there's a new unemployment benefit category. That's for sole proprietors, single member LLCs, S Corp owners that previously exempted out of unemployment, and partnership owners. So there's a new unemployment benefit category, something to check out if you fall into that category where you're self-employed, a partnership owner, and you are not having a great, it's been a little rough during this stretch. You can qualify for unemployment. Or if you're an S Corp owner that is exempted out, we think that there is a way to qualify for unemployment. There's employee retention credits. That's just credits against payroll taxes for retaining employees during this time. There's something that just barely came out, and we don't have a lot of guidance, but Idaho actually has started doing something called the Idaho Rebound Cash Grant. That's up to 10K of a grant for those that did not take the PPP loan, or that received less than 10K on the PPP loan, and that is through Idaho. That is not through the government or the federal government. There's also new rules allowing deferral of payroll taxes owed, which is something that's important. You can defer some of your payroll taxes. There's also new rules allowing acceleration of deductions through depreciation that came about with this whole COVID-19 wave of laws that was passed. There's also new rules regarding retirement account distributions and RMDs, or required minimum distributions. There's also some new rules for student loans. I'm just going to conclude with us. These are the three things that we as Keller CPAs, we specialize in, is reducing your audit risk, reducing what you owe in taxes, and reducing your tax and accounting, payroll, bookkeeping, and QuickBooks headaches. We feel like there's an enormous amount of planning opportunities that exist with these laws, and we just have found that almost none of our, most of the people out there, this is just way beyond what they want to try and do and understand. And with the constantly changing guidance, it's something you have to monitor almost on a daily type basis. I'll leave this last slide up, which is just our contact information. We're more than welcome to communicate with us, to email us, to call us, and we'll try and jump in and help answer questions if we don't get to questions here on this last segment of the show. I'm Cameron again, and Rob is my partner, and you could contact either one of us. And then Sean, I guess I'll throw it back to you for questions.
Yeah, thank you, Cameron. We've got quite a few questions, so I'll just get straight to those so we got plenty of time. The question from Joan Haynes. She runs a small medical clinic. Can I ask my professionals to change job responsibilities and help with clerical work to earn their PPP share? What if they refuse? Would I need to pay them their same high wages, or could I just hire new clerical people?
That's an interesting question. Certainly, I think that's what a lot of what we're seeing our dental and medical professionals are doing, is they're saying, hey, if you guys want to get paid, then here's what you guys need to do, is you come in and you help us do whatever we need to do. Most people are pretty open, because the other option is unemployment. So they either go on unemployment, but you can't go on unemployment. So that's important to recognize. They can't go on unemployment if you've offered them a job or a position, and you have an opportunity for them to do work. They cannot go on unemployment if there's work available and they just choose not to do it. So I would say, yeah, you definitely would want all of your people to jump in. For us in the medical world, the dental world, and like accounting world, legal world, there's a lot of continuing education that we have to knock out on an annual basis. That's a good opportunity and a good time to knock out a lot of continuing education that you have to knock out anyway. That's the time that I would grab in and jump in and do some of those things. There's a lot of times too where you're like, you have processes, you have things that you want to work on that you've never been able to work on. Good opportunity to start working on those things during this time frame and continue to pay people.
Okay. Another question from Jillian Fraw. Do payroll-related costs, including health insurance and do payroll-related costs include health insurance and retirement match?
So they do include the retirement match, that's the employer funded employer match, and the employer portion that is paid on behalf of employees. So if you're simply withholding money from your employee's paycheck, that amount does not. It's the employer portion that is paid. That is included in gross payroll numbers and that goes into the 75% number that you have to hit. So it's gross wages plus those two things. And state unemployment is another thing that factors into that as well. That counts as part of your payroll related costs.
Okay. A follow-up question from Joan Haynes is, most of my employees are part-time. How do I calculate FTE?
So we do not have the full guidance on FTE, but right now what it is the part-time people's hours will essentially be added together. And essentially determining how many full-time equivalents. So 2 part-time people may equal 1 full-time people depending on the hours. So you're going to add those hours together is what we're assuming and what we're thinking. But again, we don't have guidance on that, but that's what our best guess is right now.
Okay. A couple questions from Autumn Kersey. How do we calculate temporary or seasonal workers? For instance, we had some employees on payroll in Q1, but not in Q2 because their program ended.
So there's a different calculation that exists. I probably will not get into that right now because it just complicates things even further. If she wanted to reach out to us after, we could certainly talk to her about that offline and help. But there's a different time period that we can use to get into the calculation. So the seasonal is an exception, and so there's just different time periods that we can use to do that.
Okay. Her follow-up question is, does the SBA grant impact PPP forgiveness?
Okay, so there's a lot of confusion. The EIDL loans is an actual loan. That's the Economic Injury Disaster Loans. And in that loan, there's something called the $10,000 grant, and what it's being referred to as a grant. And that grant was designed to say, hey, we know you need money immediately, so we're going to front you $10,000, and then that will then essentially go into your bigger EIDL loan, or that Economic Disaster Recovery Loan. That $10,000, as of I think just barely, has been deemed that will be something that can be forgivable, but it will lower the amount. I know it will lower the amount of PPP loan forgiveness. If you have a PPP loan, it will lower that amount down. So you will not be able to double dip and take a loan forgiveness on the EIDL and then a loan forgiveness on the PPP loan. The other thing is the EIDL that's important to note is the EIDL loan is a loan. It is not subject to the same rules as the PPP loan because it truly is a loan. So that should not be used. The EIDL loan should not be used for payroll related costs, for rent or anything else. It should be used for all of your other operating costs because the PPP loan is the one that has the restrictions on it.
Okay. Josh Stevens, if the PPP loan becomes forgivable, would it make sense to record it as income so that it would wash out the expenses that were paid by the PPP loan grant? If it becomes forgivable.
If you want to record it as income or reduce the expenses, that's essentially what right now the guidance is showing. If it were me, I'd probably leave it on as a loan until we for sure got final rules. June 30th is the cut date. We're really expecting guidance anytime, but I would probably leave it on as a loan, other than if you just wanted to see kind of where your numbers were for tax planning purposes, I'd add that loan to your profit. But you could record it as income, but I'd probably wait until we get the final rules on that, because most of the push, there's a lot of push that says, hey, we don't want to have to count that as income. So we're looking at that, or Congress is looking at that. We'll see what happens.
Okay. Casey Huss asked a question, can you prepay rent and or utility expenses to spend out the rest of your PPP amount? This question assumes you've met the 75% payroll threshold.
Okay, so that comes back to that incurred and paid. So we believe that it has to be incurred in the 8-week time period and paid in the 8-week time period. So if we're prepaying rent, it would not be incurred because that's a future expense that has not been incurred yet. So we don't believe the prepay will work. So at that point, what you would have to do, if you can't get enough rent and you can't get enough utilities and internet, that's where you may have to look at paying more in payroll to you yourself as an owner, but there's some rules associated with that, or other employees. You would potentially need to pay them some additional funds, or it's just not forgivable and it's a loan. And then at that point, you could use it I mean, it wouldn't be forgivable essentially. So.
Okay, for a follow up of that, to clarify what you said earlier, you mentioned something about paying employees in advance to cover that June 30th date. Can you pay employees in advance?
Yeah, and now when I say advance, it's just an advance. It's not really an advance because, again, it's your payroll cycle that goes from the 1st through the 15th. You usually pay it on the 20th. But if the end of your 8 weeks is in between the 15th and the 20th, it's been incurred, but it hasn't been paid. So all you're doing is moving your final pay date into that 8-week period. So you're not prepaying them. You're just making sure by the end of the 8 weeks, they are paid for every hour worked up until the end of the 8-week period. So you're not prepaying, you're just moving the payroll time period into that 8-week window to ensure that you actually have it incurred and paid for the work that has actually been performed. Because again, usually there's a lag. Sometimes it's a couple days, sometimes it's a week that the pay period ends and that the pay roll actually goes out to the employees. You would not want that lag. You would want to move it all into the same time period.
Okay. Robert Perez asks, the loan act calculated on 2.5 months, 10 weeks. If there is a surplus after 8 weeks, can we return the surplus to reduce the loan amount in order to help qualify for the forgiveness? Or do you anticipate something like that?
So the 75% rule has to be met. If you return it, if you fail the 75% rule in the 8 weeks, then the portion becomes non-forgivable. And at that point, you have a loan on your hands. So some people are going to want to choose to immediately return the surplus funds because it's a loan and they don't want to incur the interest. So essentially at that point, they'll just return the remaining funds. But that does not get you out of the 75% rule. If you fail that test, then all of it's going to be not forgivable at that point. And so you don't want to fail that test. It doesn't matter if you return the surplus.
Okay. Follow up to what you mentioned before. If you own the business, have employees, and have not yet paid yourself, is it okay to add yourself as an employee and take a modest amount of payroll?
We believe yes, but there may be a look back where they're saying, hey, in the first quarter, you didn't pay yourself anything, and so we're not going to allow you to pay yourself now. But I do believe that you will be able to pay yourself an amount in payroll. The max that you would be able to pay yourself, I calculated it just a second ago, the max that someone would be able to pay themselves is $15,384 in that 8-week window. You wouldn't be able to go beyond that. That's the max that you can pay yourself, because I didn't even get into it, but there's a $100,000 cap on how much someone can be paid. So if someone makes more than $100,000, they get capped at $100,000 for all the calculation purposes. So that $15,384 is the equivalent of $100,000 on an annual basis. So per week, you can only pay yourself so much, for a grand total of 8 weeks of $15,384. So if I was her, I would pay myself. Yes, I would do that, but you're not going to be able to pay yourself more than that $15,384.
Okay, so that kind of answers the next question. What are the rules to pay the owner? Can I give myself a raise during that period?
Yeah, we don't know if there's going to be any kind of clawback or any kind of rules that prohibit that. But again, The max that you'd be able to pay yourself is that 15,384. I think right now I would say yeah, you probably are going to be able to pay yourself, and you could probably pay employees some type of a bonus. We just don't have enough guidance yet, and this is why I'm saying this is a constantly changing thing. So your 8 weeks is running. You constantly want to be working with someone who's going to be able to tell you the rules, because right at the end of the 8 weeks, you may have to do some things based on the current rules that you have in play that we know of at that time. And that's where I would say, if you know the rules and it changes, and then we say, yeah, you can pay yourself, more in a bonus, then at that point you could do that versus paying other employees and still qualify. But we just don't know the rules, so you got to constantly monitor that and have someone kind of helping and guiding you along that way, so that you can make decisions by the end of that 8 weeks. Because if that 8 week window runs out, you really you don't have much in way of decisions at that point.
Okay. Let me see if there's any last minute questions here. I don't see any more. Cameron, I see a lot of thank yous and great information provided. So comments. The one comment that I can answer on here is, yes, the presentation will be made available as soon as we can get YouTube to process this video. It'll be made available on the meridianchamber.org website and other locations. So yes, absolutely, this entire session has been recorded and will be made available. Cameron, any final comments?
The biggest thing I would say is just make sure this information that we're presented is date stamped as of today. And like I said, the guidance comes out so fast. I just don't want it to change and you use old guidance, because this is as of today. So just keep that in mind, that you constantly got to be looking at this, because it does change so fast. So thanks again, sponsors, and thanks again for the opportunity. It's been fun. I appreciate it. I enjoyed this kind of stuff, and hopefully there wasn't too many people that fell asleep, and we're still smiling kind of at the end of this thing. So
Nick, you want to unmute and say some final comments?
Yeah, thanks, Sean, and thanks, Cameron. We really enjoyed the information today. Really valuable information. Again, thanks to the sponsors, Meridian Chamber, Keller CPA, and Business Builder Day. If you're a business owner and enjoyed the seminar that Cameron presented, we have a lot more educational seminars going on at Business Builder Day, August 26th at the Galaxy Event Center. This is a free event, and it's a full day packed with informational seminars and networking sessions. So we'd love to have everyone join us this year on August 26th. And again, you can find more information and register at businessbuilderday.com. Thanks a lot, Sean and Cameron. Appreciate it.
thank you.
Thank you all, and thank you all for attending today. Once again, the recording will be made available on the meridianchamber.org website as soon as we can get it processed. Thank you very much.